All right, well, let's move into section number 2 and get rocking and rolling here, guys. So cover a lot in our first session this morning. Let's get into the funding side of things. Share my screen. So if you're in your manuals, we're on page number 9 of your manual. How are you funding deals? I'm about to sneeze, excuse me. All right. So the way banks accept money for a note deal is you don't show up with a case, or you're not going to go get a loan from a bank to buy a note. They accept cash wires. Now, that's not saying you can't get a line of credit. Go get a line of credit at a bank to go buy what you want, you know, a line of credit in your house or business line of credit. I highly encourage all of you, if you have not taken Merrill Chandler's course at Get Fundable, you can go to getfundable.com or getfundablebootcamp.com and check out their upcoming 2-day workshop. Well worth it, and helping you, start the process to start building credit for your business to get lines of credit. And I love what Merrill and his team does over there. But anyway, a big part of it is you're going to need cash, retirement savings. We use a lot of other people's money. I know a lot of people are using retirement accounts, self-directed IRAs. As I talk, with the different self-directed IRA custodians and trustees, their assets under management will vary anywhere from like 50 to 75% being into notes. It's either stuff that they've owner financed and originated that bought that, or they bought debt or performing notes, and they go that route. So, and if you've got all your self-directed accounts can be used to fund a note deal, whether it's a self-directed IRA, a traditional or Roth, a solo 401k with checkbook access, a SEP IRA, a self-directed health savings account, HSA, an educational IRA. Totally, you can use all types of accounts to help fund your deals. Now, you want to be very careful. You can't, there's the whole Macarena thing. You can't borrow, you can't borrow. You can partner with the IRAs of your spouses or your brothers. You can partner with your parents or your kids, but you can't, you partner, but you can't borrow money from them. So it's a big thing. You can partner where your IRA and their IRA can partner up to fund a deal, but the money's got to go back, the profits got to go back into the direct proportion of how that funding is split. You could even take your own money, cash in a checking account, and your IRA and partner with that. You just can't self-deal. And that's the beautiful thing about notes is you don't want to be self-servicing. You don't want to be collecting. You would use a third-party servicer to operate that stuff, and then they can actually literally have the funds direct deposit into your IRA account or your investors accounts if you have that set up with them, whether it's Quest or Rocket Dollar or UDirect. There's literally roughly 50. You go type in self-directed IRA custodians, you'll find the full list that are available. We're a fan of 2, Quest IRA, and then also Rocket Dollar is 2 of the better accounts out there. Rocket Dollar is much more online and cheaper. Quest is a lot more educational aspect of things. I'll tell you what Colleen says. You agree about Merrill Chandler gained 100 points in 90 days following Merrill's learning. Yeah, I agree. Phenomenal with Merrill. He can help you do a lot of variety of things. Okay, work clients and help Steph get her scores boosted in a refinance. Our scores, if I could go buy a great score to go buy trucks or whatever we need to do. So that's valuable aspect there for you. Okay. We did a webinar with Quest to break down the different types of IRA accounts. And so you can go to that link there, copy, paste that into there, talk about it. Look, there's plenty of money. What we have found is on average, the average self-directed IRA investor has around 75,000 on average. Some will have less, some will have more, but we'll have roughly about 75,000 we see, if not more. I'll put some things there. So, you can use other people's money or other people's IRAs to fund your transactions we talked about, like such as using your own stuff. Some people will use collateral assignments. They're a little bit rarer. You're going to probably get a collateral assignment from another fund or real estate investment fund. If you've got a portfolio notes, they may lend you money on that collateral of those notes so that they basically can't put a lien on a lien. Okay. But they use collateral assignments of performing notes and then they lend you some money to go. I have not done this. I've got a few friends that have done this. They may give you 50%, 60%. It all depends on the quality of the underlying notes and the percentages that they're on. So that's something to keep in mind. Mentioned this before, banks will not lend on notes, but here is a couple cool things that banks will do. But that some banks will reassign or joint venture on commercial deals, especially you get $1 million+ loan. If you're coming in and buying that note, and the beautiful thing on a commercial note, here's the thing: in a commercial note, you have the right to collect rents once it goes non-performing. You, as the borrower, often have a receivership clause in there. You can go in. Oh, you can't use it as an ATM, Mr. Borrower. You have the right to go start collecting rents directly. Once you've done that, that often takes away the motivation from the borrower who's not paying or using the rents to either sign the property over or work with you. Okay, I love this facet. And if you're going to take over management of a note, and that's one of the things that you're looking at doing potentially, and if you don't have any experience, that's okay, but you've got a good team to help you. Sometimes the banks will reassign that from a non-performing note. They'll re-collateralize the loan. I'll give you an example. Our friend Julianne, for one of our WC and crew members and student, she was buying a note on 60 units, I think up outside of Chicago or Milwaukee. I forget the city. But anyway, she was looking at the notes. The borrower was not performing. The bank wanted it off their books. So she was able to get the bank to give her a loan where they basically reassign the collateral, I won't say re-collateralize it. They originally wanted her to bring some money down. They ended up doing the whole thing and financing her loan purchase, in which she took over the property and management. And so that was a really good thing. We've done it before here in Austin, where the bank was willing to give us a loan on an REO that they took back, and they partnered with us on it. They're actually willing to provide underlying financing. Well, we had to instead of bringing a down payment, we brought the repair money to the table. And that worked out really well too. And some banks, especially like Synovus, which is a huge banking institution, it covers a lot of banks throughout the Southwest. Literally on their loan sale agreement, they're saying that if you're looking for a joint venture partner, you're looking at a joint venture on this deal, tell us what you're looking at. And literally in the past, we've written stuff out and evaluated. We end up usually just buying the notes for cash, but in some cases they came back, well, we might consider partnering with you, especially if it's $1 million+ loan. They don't want to lose that loan, but they don't want it to stay non-performing. So they can move it literally from the bad side to the good side if you're taking over management and you've got a team. So look for that in the loan. You're not going to see that on a residential loan, but you will see that on your commercial class loans, okay? And if you don't have experience, get a strong team. And that's one of the most valuable things that we'll get to is your vendors, is if you don't have a team and you're reaching out, hey, I mean, if you don't have experience, put a team. Hey, talk about your service, or get Shantae Duffy with Madison Management. Hey, that's one of your biggest things. If you have a preferred attorney network, hey, great. Here's who our attorney is in these states. Here's who our top realtors are in our top markets. Start putting that team together. Look, we're all going to be in real estate for a long time, okay? And if you've been in real estate, I don't care if you flip property or bought your primary residence is all you've got. If you've done something, hey, I've got 5 years of, if I go back to 2002, when I bought my first house, technically I got 18 years of real estate investments. For most people, their primary residence is the biggest investment. And it is an investment. Let's just put it that way, everybody. So hey, I got 18 years of real estate experience, 10 in the note space, me 15 years in the note space. And just say, hey, here's that, and put an executive summary a little bit together. Talk about your team. That's one of the strongest pieces. If a bank is asking you information and sending you more, an executive summary is great to send to the bank, but having here's a 10-page workout or 10-page document or 5-page, or, it's kind of putting your pitch book together a little bit. We did a great webinar on Note Night in America, putting your perfect pitch book together. You want to check that out on Note Night in America as well too. But talk about your team. If you don't have a lot of experience, that's okay. Talk about your team, put the types of deals, put other case studies in there to help you. Hey, here's who I rely on. Here's my team. Here's my insurance company. Here's our vendor. That's the stuff, okay? Now, here's another thing. Some people are like, oh, I'm going to go to a hard money lender and borrow money from a hard money lender. Hard money lenders are not going to lend you money on a note either. Now, I have always found that surprising, since a hard money lender is lending on an asset, they're creating a note. Some will get it, a few will get it, but others mostly won't. They want to control the asset. They want to be in the first lien position. That's where hard money lenders are making their money. Is A, the short loans, and when somebody says a mezzanine loan, that's usually a short-term, 6 to 12 month, or bridge financing, bridge from asset to permanent financing. Okay, they want to be in the first lien position because hard money lenders make their money by rinse and repeating the loan. Getting the money short-term, 6 months, getting some interest rate and points. They've arbitrage. They're paying somebody maybe 6 to 8%, and they're lending at 10 to 15% plus a couple points. So they're making that money on that arbitrage, that spread. Well, if they buy a note and it's stuck there for 2 years, they may have missed out on flipping that money 4 times. So most hard money lenders won't lend a note. Don't get me wrong. Some hard money lenders, principals, they understand that aspect. If it's a decent return on investment, might take a look at it. But most of them want to control the asset. What we have found is that most of the hard money lenders have notes for sale, especially right now with the market being where it's at. You've seen a lot of mezzanine lenders in areas of the country where the property values have dropped, or people finish a project and now they're, oh my God, we got to sell it. Most of these mezzanine or hard money lenders are at 65-70% of ARV. I got a portfolio the other day where some of them are finished and others are done. So it's all a matter of just kind of breaking out and see where everything's going. Okay. As we talked about before, make sure that you're below 70% of as is fair market value with all in. And what I mean by the purchase of the note, your foreclosure costs rolled in, any taxes rolled in, any other expenses, management fees, maybe you charge a 3% management fee, 6% management fee, whatever, your servicing, your insurance, make sure all that is below 70% of as is fair market value. Okay. You're not going to know you're not going to know the interior stuff aspect of it, but there's formulas you can calculate. That's why we buy occupied assets, less repair cost estimates. But review your values from a BPO or a qualified realtor comparative market analysis. What's a comparative market analysis? That's comps. They pulled comps. Make sure it's the realtor that pulls that it has looked at the asset, done a drive-by, okay, or peeked in the windows of the vacant. Don't judge your values off of Zillow or Trulia. Okay, yes, you're going to use those initially, but when it comes to the time of funding, when you're getting to that point of, wiring, always, one more time, always make sure you've pulled comps and or a BPO, and always had your realtor, the person pulling those numbers, look at the property. Now, it maybe require you to drive to it or fly to it, but I would prefer you find somebody local on meetup.com or realtor.com or nar.com to do that remotely for you. Have them take plenty of pictures during the day, not at night, drive by, pull comps, and go from there. Always get as is values, and then also a 30-day quick sale price. Okay. Prices will different on the BPOs. As is value may be great, but if the market's got a glutton of inventory, you may need to drop the price down so your 30-day quick sale price would be the actual valuation of that model, not the, I'm going to hold on to it for a year. You could get full value if you waited for a year in some cases, but for the most part, you want your 30-day quick sale price to be the true value of what you're looking at, okay? And then that gives you a little bit of cushion too. If we all know rehabs will go over in some cases. We figure in those expenses, especially if I'm throwing in $3,500 to $5,000 in foreclosure costs. Well, if I get to borrow to modify, reinstate in 60 days, great. My servicing and workout costs have dropped dramatically for me to do. I can take that money and put it towards another asset, or I can use that for other things if I need to. All right. But look at your taxes, talk to your servicer. Here's what I do. I'll figure in $3,500 for foreclosure costs, $1,500 for servicing, $700 a year for insurance roughly, and then taxes. Now there are places that I don't buy because the taxes are high. I don't like Wisconsin, high taxes up in Wisconsin. It's also damn cold most of the time, right? We have a little bit higher tax rate here in Texas compared to other 2.6, 2.8%. I don't mind doing it if I can get the price that makes sense. So knowing what your numbers are and figuring that into it. And always figure in paint and carpet and clean out as repair costs at a minimum for the most part. Of course, if you're reperforming, you don't need that, okay? If it's vacant, hopefully you can peek in and see what's going on. You're gonna pay cheaper for a vacant asset. Always, always, always when you're getting funding or talking with other investors, realize there are at least 5 things that protect you and your investor, okay? And this is according to Scott. 1, you're buying only first liens. That's the first thing. Hey, we're only gonna buy a first lien. 2, we're never gonna buy above 70% of as-is value. We're always gonna buy below that, okay? 70% would only be like an REO that's already basically gone the foreclosure route or right there like a week ago, a week from now, okay? Third thing we have servicing and attorneys. We have professionals in handling the foreclosures, handling the borrower outreach. No, I'm not on the phone to Cody Cox, that deadbeat borrower every month trying to get him to do. I'm not Facebook stalking him. We've got teams that are doing that for you, okay? That's I'm not going to the foreclosure auction to get that stuff done. I have attorneys that are handling that. Now, occasionally, I've had to show up at a foreclosure auction as my own witness. Okay, I had that happen in Florida a couple times. But for the most part, we got vendors that are handling it. That's a bonus. But they work in the professionals, title company, realtors, attorneys, insurance, that kind of things. Okay, so that's 3 things. 4, insurance. We're always going to have insurance on our properties, in case of an act of God. All right. Now, the big thing about insurance, you have to look into what it would cost you premium wise to get something. There are some assets that I self-insure and others that I make sure insurance, especially if it's getting in that lower asset class of really low 20 to 25,000. It's got to be damn occupied. Make sure it's occupied. Make sure it's in good condition for me to buy something that's cheap. And so, well, why would you buy a $25,000 asset? Because the borrower, it's in a great part. I've driven by the asset. It's great. It's performing. And they paid on time for a while. I'll take a look at that, okay? And then, of course, 5, we're always going to check title and collateral files. We're always going to make sure that we have the paper. Obviously, taxes is in there as well, too. And checking the paperwork to make sure that it's accurate. Making sure that we review that with a title company. Make sure that we have a collateral review company is reviewing the files, okay? And here's another important thing for you guys too. Most banks and note sellers don't usually want earnest money. Now, what you see as you start getting up the chain, you start buying portfolios or you're buying a higher asset class, then you will have probably some due diligence money that goes hard. You will have some earnest money that needs to come in. Anytime we've closed on $1 million trade, we usually had to put some earnest money up with the bank, 5%, 10%, to securitize that contract. Use it on the front end. Okay, and if somebody asks you to put 10% non-refundable on the front end side, you make a bid, don't waste your time. That's just a joker broker who's probably got their own money tied in the deal and got screwed. They get screwed, but they just couldn't perform. So you're never going to wire money of any sort until you actually have a signed loan sale agreement. Okay, please, for the love of God, don't wire any much of this, at least a signed loan sale agreement, and make sure that you've gotten a copy of the collateral files too. All right, copy means a copy, electronic, a PDF, a Dropbox file folder with everything in there, okay? You're not gonna get the hard collateral file shipped out to you before you fund. Just not gonna happen most of the time. Now, in rare exceptions, if you're buying from Bank of America in the past or things like that, we've had to go, like Wells Fargo. When we bought a 75-unit apartment complex down in Laredo from Wells Fargo Commercial Assets, what was it commercial? No, it was Wells Fargo multifamily. I actually go to San Antonio to book a time and spent 3 hours in their due diligence scanning files and pull stuff down. Most of the time, they've converted a lot of these to electronic file now, but in some cases, you have to show them locked up, and then you're copying stuff, okay? Questions about Part 6 on the funding side of things, all right? Here's the thing too. You're going to develop more funding partners the more you market, the more you're out there, the more you're sharing case studies or what you're focused on. That's one of the best ways to raise capital, just show experience, show what you're doing. Even if you're failing, sharing something that you're working on, you're working through, hey, here's assets, here's the things. There's really, if you don't have any social media accounts, you got to start being social. You can't be a secret agent man Can't be James Bond and expect to fund everything. Get anything type of funding, right? Get having anybody help. So start sharing what you're focused on. Start sharing your hobbies. Start sharing other case studies. Oh, hey, here's the type of deals that we do. Well, here's my friend Scott. He did it, closed on this deal. Here's the type of deals that we do. Start putting those out there. Hey, I did a fix and flip. Here's a before and after. Here's the lessons I learned from my first rehab. Here's a first wholesale deal. Share that stuff, okay? Yeah, Jeff, most banks, like most of the trades I've done have not had any earnest money because they realize you go under contract, okay, you don't put any earnest money up. They realize usually when you go under contract, then you've got a whole lot more due diligence. Then you're paying for O&E reports. Then you are paying for BPOs. Then you are really reviewing the collateral files. They realize you're probably going to fade your bid. And by fade your bid, if the values come back differently than what they think, or there's issues with that asset, fading means you're going to be reducing your bid. So, yeah, you're not like it when you go buy a single family property from an agent and you got to put $1,000 down or $2,000 down in earnest money. No, banks don't want a $1,000 wire. Just send me a full wire. It's more complicated for their bookkeeping for you to send it up. Now, unless you're putting 5%, that's usually going to an escrow account with an attorney, so it doesn't script, so they get one wire. But yeah, Jeff, that's the beautiful thing. When I was a new real estate investor, and I want, what's a lot of agents say? Oh, put 20 offers out on REOs. Well, that means I got to write 20 earnest checks and 20 option fees. That can get expensive, especially if it's not with the same agent. Okay, that's not fun. So yeah, that's the beautiful thing. I make bid on 60 assets. It could be a $600,000 trade. I know I'm probably get 30. Okay, then they just want to know when you're going to close. Okay, you're closing 2 weeks after acceptance. Okay, great. 3 weeks after acceptance. Yeah, accepting when you start getting the commercial assets or you get a larger portfolio, the bank's going to then want you to see proof of funds. They're going to often want to see some sort of earnest deposit at that point. Okay, did I just blow your mind there, Jeff? A lot of people like, oh, that's cool. All right, and that's the thing. Most new investors will have only about a 10% closing ratio. Now, what does that mean? Closing ratio means if you make 10 offers, you might close on one. If you get 10 approvals, you might close on one because due diligence, pricing, workout strategies, you filter through a lot. If I make 60 offers, I know probably right off the back, I'm probably only going to see 30 accepted. Maybe too low, the others may be under contract, but of that 30, I'll probably whittle that down to 15. Biggest mistake I see investors making is they take forever on the front end trying to do diligence and they make one offer or two offers, and then that's already bid up by somebody who bid in 24 hours versus a week. So I'm a big habit of taking my spreadsheet, running formulas down it, identifying some things, sending that in, and then getting my true final approvals or counters, and then doing a deep dive. It's like a two-phase approach. Unfortunately, most note investors will do all this due diligence on the front end, and they end up with nothing because by the time they get around to submitting a bid, the bids have already been accepted by others. Capiche? Claro? Is that clear? All right.